Thank you for joining us today for our webinar about stealth taxes that may cost you at tax time. My name is Sammy Azuz, and I'm the president of Heritage Financial, an independent wealth management firm based in the Boston area that helps people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning. With me today is my colleague and good friend, Ed Jastrom. Ed is our director of financial planning at Heritage and probably the strongest financial planner I've ever met. Welcome, Ed.
Thanks, Amy. I appreciate that.
Absolutely. So, Ed, this was a topic that was near and dear to your heart. And so let's start off by just explaining at the outset, what is a stealth tax?
Yeah, I think there's a couple things that in my mind make a stealth tax a stealth tax. The first is that they tend to operate outside of regular tax brackets. So when we think about our taxes and we think about our income, it's very typical that we look at how much we make, how much we made in our portfolio, and then we look at where that falls in a tax bracket and we say, I'm in the 24% bracket, I'm in the 32% bracket. Stealth taxes operate almost entirely outside of that calculation, and they tend to be in addition to the brackets. The other thing that makes stealth taxes what they are, in my view, is they tend to creep up on us. They're sneaky. What we've seen over the last few years is that they might start to impact a client of ours at a very small level, a few $100s. But then as time goes on, it's a few hundred, and then a few thousand, and then it could be a sizable amount. So those two aspects of being outside our normal tax talk and creeping up on you are, I think, what makes a stealth tax a stealth tax.
Got it. No, that makes sense. I would imagine people hate having tax surprises. And so with that definition in mind, I would imagine these taxes have been around in some form or fashion for a while. Why is this more on our radar screen today?
Yeah, good question. I mean, some of it comes from recent tax law changes over the last few years and just legislation. But I think more so why we're talking about it today and why we're seeing it more often in our practice really has to do with economic growth. If you look at portfolios, if you look at real estate values, we look at wages, inflation recently, and something else that makes these stealth taxes creep up on you is they haven't been indexed for inflation. So individuals who weren't really experiencing an impact from them a few years ago, even without much changing, can start to see an impact over time, just as cost of living increases.
Got it. And so, as we talked about this, there's a lot of potential stealth taxes that you can focus on. We wanted to narrow it down to maybe the ones that our clients are experiencing the most, and where we have some actionable ideas as to how to help people avoid or minimize them. So which ones did we pick? What stealth taxes are we seeing having the greatest impact right now on the clients that we work with?
Yeah, absolutely. And as I continue to move forward, can you see my screen okay, Sammy, with this list?
Looks great. Thanks, Ed.
Excellent. So the three that we were focusing on to talk about today related to the potential for a capital gain on the sale of your residence, the net investment income tax that we can call NIIT for short, and the SALT cap, or a cap on state and local income tax deductions.
Okay, so let's dig into each of these specifically and maybe talk about what individuals can do to try and manage their expectations and tax liabilities in each of these areas, and we'll go through them in order. Let's start with paying taxes on the sale of the residence. The real estate market is hot. Houses are going for a lot, over asking. People are getting more, I think, than they anticipated selling their homes for. What is going on with the capital gains tax exclusion, and how is that turned into a little bit of a stealth tax?
Yeah, definitely. Let's look at the rules and then kind of talk about what's happened since these rules were put into place. So most married couples, when they sell their home, are allowed a maximum exclusion of $500,000. Okay. So if you bought your house for $500,000, it appreciates over time to $1 million. You sell it for $1 million. you have a $500,000 gain, you could exclude that gain entirely and it's not a taxable event.
Okay.
For single individuals, it's half of that or 250,000. There's a couple other rules that come into play related to how long you've owned your home and how long you've occupied your home. And what's happened over time is when Congress put these rules into place, I think they really intended for virtually no one to pay a tax on the sale of your primary residence. And I remember, many years ago, studying for the CFP, learning these rules and lots of examples with them, but then, coming into Heritage shortly thereafter, almost never seeing it come into play. Really rare that you would ever see it applied. So the rules are embedded in our learning, but it really hasn't been until recently that we've seen more instances where we have to really pay attention to this. And if we look at just visually kind of where home prices have gone over the years of, as you were saying about, what we've seen in the last couple of years, especially with values just skyrocketing. This is a chart of home prices in Massachusetts starting in 1997 and going to present. And you can see 124% increase. I think if you looked at metropolitan areas closer to Boston, it's even higher, 140% or so over that time frame. And this is really why we're talking about this, because something that wasn't an issue for a lot of our clients many years ago now could be, if they're looking at selling their homes or moving, downsizing, or right sizing. And the reason being that this chart starts at 1997 is that's when this rule was made, and it hasn't been adjusted for any changes to real estate values or inflation since then.
Yeah, and I would imagine if you've lived in your house for a really long time, you're seeing increases from well before 1997 that are making this a bigger potential issue for you.
Absolutely.
Yeah. Okay. So what to do about it then? How should people change how they think about selling their home based on this stealth tax, assuming the exclusion amounts don't get adjusted?
Yeah, I think, first of all, is there even a gain, right? What are we talking about? That's usually the first exercise that we need to think about. So we're looking back at, what did you pay for your home originally? And then what have all the capital improvements been over time? And that's really important. It can't be, overstated enough that keeping track of the improvements to your home over time makes a big difference when it comes to selling in the future. So, the bathroom upgrade, the kitchen upgrade, the new fence, the major landscaping, all of those things over time, keeping good records and knowing what your adjusted basis is really the first step in, being able to manage this. And that's why we kind of ask for that information when we can and build it into our financial plans.
Yep.
I think the other thing is just planning ahead, right? So the more time we have to kind of think about what's going to happen in the future, thinking about if there is a sale in the future, why are we moving? Is it more cost effective to make changes to the house to be able to add longevity to a home and age into a home versus moving someplace else? And then I'd say lastly, it's again, timing. So sometimes we have the opportunity to plan ahead where, let's say there is a gain, there is going to be a taxable event. If we can make sure that that taxable event doesn't overlap with another one, like a big payout from a retirement plan or a bonus, trying to make sure that we don't have one tax year where there's a lot of income that's all, pushed into the highest brackets. That's something where we're not necessarily getting rid of the gain on the home. We're just making the entire situation less worse by managing the timing of events. And that's just about communication and planning ahead.
Sure. And so that really entails building a pretty detailed financial plan with your advisor so you can project out some potentially bigger tax years to avoid making even worse with something like this.
Yeah, a detailed plan and good communication.
Right. Okay, that's helpful, Ed. And I do want to mention for our attendees that we'll be sharing a copy of this home improvement worksheet today with you. It's a really helpful way to make sure you're documenting improvements that are part of the adjusted cost basis. And so look forward to that, and hopefully it's a helpful resource. Ed, let's shift gears a little bit and talk about the NIIT, the net investment income tax, because you had mentioned that as a second stealth tax that we're seeing more of. But first, since we shared some jargon and acronyms, let's just start with what it is.
Right. So the net investment income tax, or NIIT, first appeared as part of the tax programs that were designed to fund healthcare reform under President Obama. And this is a tax that can apply to gross income. And what ends up happening is kind of formulaically, it either ends up applying to the amount of income you have over a threshold, or it's applied to your actual investment income. So let me walk through this example to try to explain that if I can. Imagine a situation for a married couple where they have wages of $340,000. And that could be wages, it could be pension income, it could be Social Security, anything other than your portfolio income. In addition to that $340,000, they have investment income of $60,000. So that's interest, dividends, capital gains. So their total gross income before any deductions, before any other credits, is $400,000. For a married couple, the threshold that applies is $250,000. So in this example, they're over that threshold and they're over it by 150 grand. The tax is 3.8%, and it applies to the lesser of your actual investment income or the amount over the threshold. So in this example, the investment income of 60 grand is less than 150. The 3.8% tax applies to the 60 grand. That's $2,280. The $250,000 threshold for married couples has not been adjusted for inflation for 10 years. And that gets back to what we were saying at the start, that this is one of the ones that creeps, right? You could have someone who is a high income earner and maybe was hit by this just a little bit. And as time goes on, wages increase, the size of your portfolio increases, you have higher bonuses, maybe stock options, all these things could increase and increase. So now that we've seen that over the last decade, it's definitely something we're seeing more of.
So pretty detailed and obviously technical stuff. It was a great overview. I think people definitely can understand it more now after that. How do you process this though? This one's a little bit tough because markets and incomes going up is a good thing. So is this just a tax increase that you have to live with, or are there actual ways to manage it?
Right, that's a good observation. It's something that we see where if you're paying more taxes because you're increasing your wealth and your income, it's hard to say that that's a bad thing, right? But there are things that we can do to try to manage this. One of the first things that we look at with clients is really, are there advantageous things that we can do to lower your gross income in the first place? And the first place we go to that tends to be for people who are working, or for people who are self-employed and have businesses. What benefits do they have that might be tax deferred? Mm-hmm. So things that we can use that just lower gross income in the first place. Retirement plans, making sure that people are maxing out their 401ks or their 403bs, that when they turn age 50, or if they're older age 50, they're also contributing the catch-up contribution if they can. Other benefits like Flexible spending accounts. There's flexible spending accounts both for healthcare and for childcare. Looking at for executive compensation, things like deferred compensation in addition to a 401k. And health savings accounts are also all vehicles that might be available to someone that, it's the low-hanging fruit of just making sure that we're capitalizing on these things, before we do anything more complicated.
Yeah, that makes a lot of sense. I know with the business owners that I work with, and obviously not everybody is a business owner, there is a lot of lost opportunity to be deferring more income and avoiding this through more robust retirement plan designs. So that's an important consideration too to add to this if you are a business owner or self-employed. You mentioned that the NIIT is on gross income, so it includes income made from investment portfolios. At Heritage and some other places, we focus on things like asset location and lower turnover strategies for taxable accounts. Talk a little bit about how that helps impact this as well.
Yeah, that's the other part of it. So we were just talking about, deferring some of your income into retirement plans, into, flexible spending accounts. But the other side of it is the investment income. It's how we're generating the return. Are we paying attention to, capital gains? And I think that we do a very good job of what you just mentioned, looking at not just what we own, but how we own it, in what accounts. Are we trying to do a good job of positioning our portfolios so that we meet the risk and return objectives that help clients with their goals, but do so with some tax awareness? What I would add to that is I think it's important not to have tax planning as the primary driver of portfolio construction, right? It's more important to have the investment objective that meets our clients' needs and to make sure that those expectations and diversification are really important. But we do that with tax awareness. So it's the combination of the right portfolio with tax awareness without letting taxes drive the primary decisions, I think is something that we do really well.
Yeah, and connecting this a little bit to the capital gain exclusion topic on real estate, there's probably also an opportunity to use the financial plan to communicate with your advisors so that you're planning for funding an opportunity or a big expense as it relates to some of this?
Yeah, there's definitely a lot that kind of what I said about, the timing of a home sale and trying not to overlap a big gain on a home with something else. That also comes into play with managing the NIIT. So if we know that there's some future activity going on about things like a bonus, exercising stock options, or retirement plan withdrawal, there's tools that we can utilize to try to help manage having a lot of income all at once. And in doing that, it might lower the exposure to NIIT in any one year. So if you think about the instance where someone needs capital, there's an expense that someone needs to fund, so they withdraw money from their portfolio to fund it, or they sell a security at a big gain to fund that expense. If instead of doing that, maybe we can bridge something, maybe we can use a margin loan for a few months from the portfolio, or maybe a client has a home equity line of credit and they can use that. So think about the instance where you have a big bill due at the end of the year, but you're getting a bonus or a RSU or a stock option payout a few months later. If you funded the expense at the end of the year by selling something, creating a big gain, paying taxes, paying NIIT, alternatively, you could use margin or a line of credit, borrow that money a few months later, pay it back. Right now, the cost of interest on short-term borrowing is potentially a lot less than the tax cost. So there's things that we can do with clients. We plan ahead of time to manage the timing of events like that could be really effective.
Yeah, that makes a lot of sense and good advice. And I think one thing I should mention is we are going to take questions that you can submit through the Q&A box down below, and we'll try to answer as many of them as we can before we leave. We did get one that I think is particularly timely on this topic. Is NIIT calculated differently for a single person, Ed?
Yes, the threshold is different. It's 200,000. So a single person has to be pay particular attention to it because the threshold is lower. So everything we just said, the same logic, the same planning applies, but instead of being based off of $250,000 threshold, it's 200,000. And similarly, that $200,000 threshold has not changed in 10 years.
Got it. Okay. So let's get to the final stealth tax that we're talking about today. This one people may be more familiar with because it became a little bit of a political football over the last few years. The SALT cap. What's the SALT cap, and why are we talking about it in this context today?
Right. So the SALT cap isn't really a tax,
Okay.
but it acts like one because it lowers deductions that might otherwise be available. So it's a stealth tax in that regard. The SALT cap took what was otherwise available for a lot of people's itemized deductions and put a limit on it. And the limit exists where we would normally be able to deduct taxes that we paid at the state level and property taxes. So that's SALT, state and local taxes. The local taxes almost always just being property taxes. So here's a kind of straightforward example to try to illustrate what was happening before the SALT cap limit and what's happening now. So if we imagine a married couple before the SALT cap, and they had state taxes and property taxes that together added up to about 20 some odd thousand. They have a mortgage, so they can deduct their mortgage interest of 7, and they made gifts to charity of 5. Those together add up to 34,000, and that's what would have been their total itemized deductions. Now the SALT cap is applied. So same situation, but just the SALT cap goes into effect. The SALT cap is $10,000.
Mm-hmm.
So this couple still paid $22,000 in their state and property taxes. They just can't deduct it all. They're capped at 10. Same mortgage interest, same charitable gifts. So now all of those deductions add up to 22,000. But the standard deduction is now 25,900 for a married couple. So in this example, what actually ends up happening is you're not itemizing your deductions. You're just taking the standard deduction. So the 5,000 that you gave away to charity still benefits the charity, but you're not actually getting a tax break for it because you didn't get to itemize, you're using your standard deduction. And that would keep happening pretty much year after year after year, where you could still enjoy giving to charity, but you're not getting a tax break that you maybe thought you were getting. And that's the biggest part of why the SALT cap is a stealth tax. It's because people might be donating to charity thinking they're getting a tax break, but you're not. So it's really shifted how we have to pay attention to effective charitable giving as part of tax planning.
Yeah, no, absolutely. That's a great example. And thanks for sharing it. I think it's well put together and really crystallizes the issue. So the $1 million question then becomes, what have we done about it for our clients? What can people do about this?
Right. There's two big things that have come into play in the last few years since this came into effect. And this was part of the Tax Cut and Jobs Act that was put into place at the end of 2017. And those two things that we've been able to do very effectively that people should be on the lookout for and talking with us about are bunching their charitable gifts. And for those who are age 70 and a half and older, QCDs, or qualified charitable distributions. Bunching gifts is using a donor advised fund most often, where, let's say in this example, this couple is traditionally giving around $5,000 a year to a couple charities. If they kept doing that every year for the next several years, if this doesn't change, that they're never getting a tax deduction for that charitable gift. But let's say instead of giving a few $1,000s every year in successive years, you do it all at once. So you give 20,000 or 25,000 all at once. That's going to allow your deductions to exceed the standard deduction in that year and get an itemized deduction of benefit for those charitable gifts. The way you use a donor advised fund is you can make one gift, larger gift of that 20 or 25,000 to a donor advised fund. And then the donor advised fund can be invested and it can grow. And then you use that as a funnel to give to the charities over the next several years. So the timing of your transfers to the charities doesn't change. You're just timing your tax deduction differently in order to capitalize on the difference between what you could deduct and what you can't based on the SALT cap.
So they've become more valuable probably and more popular as a result of this, these donor advised funds.
Definitely. I think we've seen a fairly substantial increase in the use of donor advised funds since the SALT cap was put into place. And it also goes hand in hand with market performance over the last several years. Donor advised funds are really valuable because they allow you to transfer appreciated stock into them, and you could potentially get the tax deduction, but also avoid a gain that you would have realized if you sold that stock. And with the way the markets have performed in recent years, there's a lot of individuals that have highly appreciated securities that are much more effective for charitable giving than just giving cash.
So does this then also help a little bit with the NIIT?
There's a big connection there, absolutely. So definitively the combination of strategies where you're looking at the portfolio, you're looking at a lot of unrealized capital gains, you're looking at how to rebalance a portfolio without incurring the wrath of the NIIT. There's definitely strategies that play well together if we look at them in this way.
Great. Any other strategies that we're sharing or utilizing to address these unintended consequences of the SALT cap?
I think the QCD I mentioned is one of them. For individuals who are over 70 and a half, you're able to send some or all of your IRA distribution directly to a charity. And in doing so, it doesn't show up really on your tax return at all. It's almost like that income coming out of your IRA just doesn't exist. So for individuals who have IRAs with required distributions, that can be a really effective way to manage kind of around the charitable giving SALT cap issue, and something that I think has been really effective for the last few years as well.
Yeah, okay, that's helpful, and we have been doing a lot of those as well with our clients. There's something related to a Massachusetts pass-through business owner opportunity that's probably too deep to go into detail here and pretty highly circumstantial. But if you are a business owner and like to learn more about that, definitely reach out to your wealth management team if you're a Heritage client, or to us directly if you're not, and we could talk to you a little bit more about that. So, Ed, we probably shouldn't be expecting or hoping for any changes to these stealth taxes, but it sounds like with some advanced planning, we have the opportunity to minimize the impact of them. So what I've taken away from this, and please let me know if I missed anything, as a quick review, is it's important to track home improvements and keep an up-to-date adjusted cost basis of your home, maximize tax deferral opportunities, definitely build a cash flow model or plan with your advisor so you can be projecting out bigger tax years that you want to plan around, using a donor advised fund potentially to bunch charitable contributions to maximize your deductions, and I mentioned the business owner opportunity as well. Is there any other advice you have before we wrap up and take questions?
I think what you said are the big ones. I would add that, and you hinted at it, but just having a good plan, in the first place.
Yep.
I think that's something that, our clients benefit from in terms of, just having something that is a roadmap to use, to have illustrations for the future, and to be able to use it as a guide to try to help make decisions. So having a good plan with good assumptions and good information. And, if we're asking for a copy of a pay stub or a tax return or your employer benefits, a lot of why we're digging into that information and looking for it is so that we can, look at what's going on behind the scenes with opportunities that we want to make sure that we're checking the boxes and taking care of, because they all play into a lot of what we were just talking about.
Okay.
In addition to having a good plan, communication, I think, is very important. Talking with your advisors about what your goals are. Has anything changed? Do you have anything going on in your life that could impact what the plan is, so that we can, incorporate those, what ifs and do some stress tests in the plan and see what's going on. If we can't do something to minimize or eliminate some of these stealth taxes, we can at least be prepared for them.
Got it.
And avoid any, snowball effect of accumulating issues because we weren't prepared for something that happened. And I think that's kind of the best of everything that we can offer.
That's great. I think that's all people can ask for. We definitely have some great questions that came in while we were going through this. The first one is one we get a lot that I will just answer quickly. Can the QCD go into the donor advised fund, or must it go directly to the charity? Unfortunately, it cannot go into the donor advised fund. It must go directly to the charity. The second one, Ed, is does putting in a pool count as a capital improvement to add to a home's basis? And what are some commonly missed items that homeowners should track?
Yeah, putting in a pool should add to the adjusted cost basis. The IRS, in terms of what they're looking for about capital improvements, basically says that it has to add value, prolong the life, or adapt the home to new uses. So that's the kind of general concept of what a capital improvement is. Repairs don't count. So if your heater breaks and a repairman comes and fixes it, the cost of doing that doesn't count. If you replaced it entirely, it would. I think in terms of commonly missed improvements, I don't know if there's anything that really stands out from my experience with clients. I think it's more so just keeping good track of it and keeping good records overall.
Great, and that worksheet we send out should hopefully help in that regard. So Ed, thank you very much for joining me and sharing your insight with everybody today. I think it was very helpful. Taxes are on everybody's mind. Tax time is right around the corner. And thank you all for joining us today at our webinar. If there's anything we can do to help you personally improve your finances, please don't hesitate to reach out, and have a great day.